We downgraded the tech sector in last April already, so we saw an overvaluation, but now we start to see value coming up in many of these companies. And I think probably a bit of the downside has been exaggerated. But it's also an expression of what's happening on the trade side, and I think it's exactly these companies that are really fitting in this global supply chain that now are feeling the pain, and that has some negative impacts basically for the larger markets. And I think that's something definitely to monitor and to watch.
Now we're keeping an eye out on the slowing Chinese economy and the impact on the Chinese consumer. When you talk about the different sectors that you're watching, Apple was the first one to come out to flag this renewed guidance. What other sectors here are at potential risk with this slowing Chinese economy?
Well, we definitely see the manufacturing sector gets hit. So we see that a lot of companies starting to shift their production to the ASEAN countries, Cambodia, and all such countries. So the manufacturing part got hit. We saw front loading on some of the imports in the US, and now basically manufacturing will slow down. And this has basically also reflected in some of the PMI numbers that came out yesterday, for example. So we can see the slowdown, but it's a global slowdown. We should not forget also the US, we do expect actually to start to slow down in the fourth quarter already, and then in the first quarter 2019 in particular, related to these trade situations that we actually have.
Matt, come on in here.
Hi, Adrian. It's Matt here in Sydney. Great to chat to you there. Just want to pick up on that theme there. Of course, we're counting down to US earnings season, which will be kicking off in just a few weeks. Are you expecting to hear from other major US corporates as well about the trade war biting? I know Emily just asked you about some other sectors that are exposed, but do you think we might see perhaps as we move into the earnings season a bit of a confession season where other companies similar to Apple come out and say, you know what, we're also experiencing similar things? And then what would that do to US markets, which of course are coming into 2019 off a pretty rough 2018?
Yeah, absolutely. Clearly, so if you look at GDP numbers at the moment, the Q4 is tracking on our numbers around 2.4, significant slowdown in the US, and we do expect it actually slows down to 1.5 in the first quarter. And so China's exactly also slowing down. And this should also be reflected in some of the earnings numbers. Now, fourth quarter earnings numbers probably in the US still come in on the stronger side, but maybe a bit less than expected because we still get benefits of the tax cuts. But there will be probably also some companies that will use maybe the environment, the more difficult environment related to trade. And that's something probably the Trump administration has underestimated, because these are the large heavyweights on the stock market. They have an impact also on the wealth effect in the US, on investor sentiment and investment sentiment of the corporates and the CEOs. And I think that was slowly starting to play out. What does that mean for the equity market? Of course, we have a lot of headwinds, but you should not forget we have seen a derating basically of 20% in the US, or more than 20% after the sell-off we had late last year. And we do see value. So how we're positioned, we still overweight equities on a global level. We do think there's upside, there's value, but we also have started to buy put options to protect basically some of the uncertainties that we will face over the next couple of weeks.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.